Todd Boehly of Eldridge Industries joins us once again. Thank you for spending some more time with us. Let me just get your broad view on where you think we are in the markets these days. How do things look to you? We visited a year ago, looked all right. The Fed you thought was done hiking. Now they're starting to cut. Just give us your read on where you think we are.
I think we're in the process of having lots of M&A get started. I think we're seeing more and more activity. I think we're seeing people want to transact. People have to kind of get back to, the transaction business. So, across our portfolio, we're seeing lots of kind of merger and consolidation discussions going on. I think some of them are in their earlier days, but I think the animal spirits are coming back and people want to get back to it.
Really?
Right?
It's interesting that you have that view. I mean, people have been looking for capital markets to reopen. I had a conversation not that long ago with David Solomon of Goldman Sachs, who's maybe more optimistic than most, but even was like, okay, let's get this started already. What's going to kickstart it?
I think ultimately the fact that private equity firms have to recycle capital is going to be the thing that drives the whole process back again. And I think you're starting to see, 2023 was a tough year, and I think scale is going to continue to get more and more important. And as long as kind of scale continues to be, the thing that people are focused on, you're going to see consolidation, you're going to see M&A, you're going to see, a lot of activity, in my opinion, coming up.
Yeah, I mean, that's been one of the key questions, specifically as it relates to private equity, the lack of realizations. The lack of exits, but you do have a sense that we're about to have a page turn in that story?
It feels that way. I just think there's a lot of activity out there. There's a lot of conversations going on. We're seeing these consolidation discussions come up, in every industry now. But I still think the consumer's doing well. I think that if you look at just hotel room rates and ADRs and what's going on across our portfolio, whether it's the Raffles in Boston, the Hilton here in LA, Aman in New York City, these are all doing very well. And I think they're a testament to the strength of the underlying economy.
Are you reasonably bullish then on the overall economy and the consumer, soft landing, no recession? Where do you come down on that question?
To me, it just feels like, we're continuing to plow along and people are continuing to feel reasonably good. I think, if you go back and look at history, a 4% 10-year doesn't seem to be, a horrible interest rate environment to be in. And I think we're going to continue to see the front end come down and the curve will flatten. And I don't think the 4% 10-year environment is one that will be prohibitive for business.
How does it impact things like, part of your business, private lending, credit? Where's demand in this changing interest rate world?
We're continuing to see strong demand for credit across the board, whether it's equipment financing, private credit, broadly syndicated credit. There's definitely a tension right now between the private credit markets and the broadly syndicated loan markets. Both of them want the volume. So you're seeing them get a little more competitive with each other. And I think that's good for borrowers, it's good for the country, and it's good for access to capital. I mean, the thing that makes America so great is our capital markets are by far the deepest, right? So if you look at how much volume there is in the Saudi stock exchange in 1 year, it equals basically 1 day of NASDAQ volume. So when you think about the liquidity in our marketplace, it's just awesome. And I think that's really the edge that America has, and that's what everyone wants.
I feel like you can't either turn on the TV these days or open a financial-related, newsletter or newspaper and not have the question asked, is private credit a bubble? I'm curious your thoughts on that because everybody seems to be discussing that. What are your own thoughts?
I think if you're not a practitioner, it's hard to sit here and kind of suggest that something's a bubble, right? In the end, you're lending money to these businesses somewhere between, let's call it 4.5 and 6.5 times. And these are businesses that are worth between 9 and 11 times, right? So as long as the businesses are worth more than the debt, the lenders are going to be fine, right? So, I think when you look at what happens in industries get sick, and then the credits within the industries get sick because the industry gets sick, right? Whether it's energy or telecom, if you go back and look historically where defaults happen, they're congregated around industries when industries get sick, and then the underlying companies get sick. I don't really see a whole lot of industries that are sick right now.